Good afternoon, ladies and gentlemen. Welcome to the In the Style Group PLC annual results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, I'm sure that would be most welcomed by the company. And I'd now like to hand over to CEO Sam Perkins. Good afternoon, sir.
Good afternoon. So firstly, thank you and welcome to everyone who's joined for the financial year 22 results for In the Style. It's myself, Sam Perkins, and I'll shortly introduce Richard Monaghan, who is the CFO alongside me at In the Style. We're delighted to have you here. So a little bit of introduction to me. I joined the business in January this year, so I've been in role for 6 months. Prior to that, I led the retail team at the Very Group, the privately owned retail financial services digital pure play business, where I spent 4 years as managing director, and prior to that, 3 years as group merchandise director. And then prior to joining the Very Group, I spent 7 years at Tesco in a variety of commercial and marketing roles. I started my career in FMCG working for PepsiCo. If I hand to you now, Rich.
Thanks, Sam. Good afternoon, everybody. I'm Rich Monaghan, the CFO here at In the Style. I joined the business in March this year. Previously spent 12 months at Victorian Plumbing Group PLC, helping them through their IPO last June. And before that, 7 years at Auto Trader Group PLC, helping them float in 2015. And then having a number of roles through finance over the next 7 years.
I'd like to feel that what Rich and I bring is deep digital experience in consumer, successful track records in growing businesses and operating in well-managed, well-controlled businesses. Alongside us, working closely with Rich and I is Adam Frisby, the founder of In the Style. He founded the business just under 10 years ago. And with me joining as chief executive, Adam stepped into a chief brand officer role, which encompasses product and all of our relationships with influencers, as well as brand marketing. What Rich and I will talk to today is 3 things, really. Highlights of the financial year that has finished, financial year 22, which concluded at the end of March, and we'll dive into some of that detail. We'll talk to the strategy that we see for the business to sustain a high level of growth. And then we'll also talk to what we expect, what we anticipate to deliver in financial year 23. I thought it would be helpful to start with to share my reflections after 6 months being the CEO of In the Style. And it was a business that I was very excited to join, and that excitement remains. Firstly, it's a very, very well-positioned business, and I talk to these 3 components a lot to my colleagues and to investors like yourselves. And so the 3 components of the business which make us highly distinctive and position us very well for growth are: the first is it's a really inclusive brand and product. So we've got a very, very strong brand with inclusivity at the heart of it. The second is we have a unique social influencer model. We partner with influencers to launch capsule collections of 20-25 products where they input into design. They help us market those products, and we launch roughly 4 times a week, mostly in the evenings. And supporting both the brand and the social influencer model is an agile supply chain, the ability to watch, learn, listen, and effectively test and learn with product, and do so in short lead times. So the first thing is the business is really well positioned. The second is it's healthy. Richard and I will talk to the performance for last year, but one of the clearest signs of the potential is the performance of the customer base. Last year, we grew the customer base, we increased frequency, and we increased the average item price. So we saw really good movement in our customer metrics, and it gives us real confidence to think we can leverage that customer base further. There is a reflection joining a new business, certainly one that's been founder-led, one that has successfully grown. The business has almost trebled in the last 2 years. Richard will talk to the detail. and one that successfully performed through a pandemic, not just growing during the pandemic, but for successfully holding all of that growth and growing again last year. So it's a great business at heart. There is a need to re-engineer as we scale the business, and I'll talk more about that as we go through, and we see clear opportunity to do two things in doing so. One is improve the cost base of the business, and the second is create the time and space to prosecute the strategy that I'll talk to. If I now move on and talk to essentially strategic highlights, financial highlights and operational highlights, and then hand over to Rich, who will go into more detail on the financials. So you'll be able to read in front of you a number of points. I'll talk to 2 or 3 of those. So one of the biggest strategic highlights of last year is we signed 10 new influencers, which took the number of influencers that we partner with to close to 30. So significant growth last year. Stacey Solomon was the biggest example of that, and we did record revenue on our first launch with Stacey, taking over £1 million of gross order value, so that's prior to returns, in the first hour, and processing 500 orders per second at the height of that launch. Now, at the Very Group, I've got some experience of order velocity when we were putting PlayStations and Xboxes live last Christmas, and 500 orders per second is significant velocity. So it shows the popularity of the model and our ability to handle volume. The third thing I will talk to is the consumer engagement evidenced by the app. So we had 850,000 downloads of the app last year. And for those who don't know, we launched for the first hour. So of any launch, the first hour is exclusively available via the app, which encourages customers to download it. And we can then see, as a result of having the app, our conversion is stronger. I would also just like to touch upon actually something that happened after the financial year closed, but something we're proud of the contribution we made, and that's the partnership with Dame Deborah James, the lady who was unfortunately suffering from bowel cancer, who has sadly passed away since. But Adam and Deborah had worked together across the course of the last year on a collection. And as it became clear to Deborah that her health was sadly deteriorating, Adam and Deborah decided to launch a T-shirt where all proceeds go to the Bowel Bank Fund for Cancer Research. And I'm proud to say that we've raised so far £1.25 million in just under 3 months. So I think it shows the strength of our purpose and what we can do when we really put our minds to it. Touching now upon the financial highlights, essentially what did those strategic highlights deliver? And I talked to 3 things. The first is that we grew revenue 28% year over year. Richard will talk to more of the detail behind it. And as I said previously, almost trebling the size of the business in 2 years. Despite inflationary pressures, gross margin in our D2C business, so that's direct to consumer or e-com business, held flat on an underlying basis year over year, despite those inflationary pressures. Rich will talk to, we did see some softening of the margin in wholesale, and we did see the total margin decline partly as a result of the wholesale mix. Now, we delivered 1% EBITDA and £600,000 of EBITDA, which was lower than the prior year at 3.8 million and lower than was guided at the beginning of last year. And we're clear on the reasons for that. Essentially, as the business scaled, the cost base grew due to people costs, as we developed more product and as we worked with more influencers. As we processed more orders, our warehouse became less efficient. And as we professionalised the business, having become a listed business at the end of financial year 21. We've got a good handle on those 3, and Rich and I will talk to them as we go through, and we see a clear sign to improving the cost trajectory as we progress through the year. If I now touch on the operational highlights before handing over to Rich to talk in more detail about our financial performance, this is a business that scaled well last year, reflected in that cost base. So we launched 193 collaboration collections across 27 influencers, meaning we developed 7,500 new products. Now, when you consider we go from size 4 to size 28, and we serve customers in petite sizes, tall sizes and regular sizes, that's a significant amount of new product, and I'm proud of the way the team responded to that velocity. We served a number of customers, and as I said at the outset, our frequency improved, our average item value improved, and we saw the overall base grow. There is an opportunity there to retain more of our customers by serving them better in between launches, and I'll talk to that later on. Rich, if I now hand over to you to talk us through the more detailed financial performance.
Thanks, Sam. Starting with revenue. So revenue increased by 28% to 57.3 million, with good levels of growth coming through both of our direct-to-consumer and wholesale channels. Wholesale revenue, which is generated through sales to third-party retail partners, increased by 52% to £12.6 million and represented 22% of total revenue. The brand's association with high-profile online retail partners such as ASOS and the Very Group provide a profitable revenue stream and access to a broader consumer base which increases brand awareness. Through the year, we continued to test and learn by entering into our first partner based in bricks and mortar stores. This partnership increased our brand awareness and contributed meaningfully to revenue, but retailing in stores has proven a challenge with our launch model, and we are now considering how we best serve this section of the wholesale market. D2C revenue, which is generated through the sale of apparel on the group's platforms, increased by 23% to £44.7 million. This was achieved through increases in total order volumes and the average revenue per order. The group leverages its distinctive collaboration launch model with influencers to drive engagement with consumers. An increase in visits to our platform was amplified by an increase in conversion and resulted in a 13% increase in the total number of orders to over 1.5 million. These orders were generated from 677,000 active customers, which is an increase of 4% on the prior year. As Sam will touch on later, we are pleased that our active customer base continues to grow, but we do recognise the level of churn in the base gives us huge opportunity for further growth. Finally, average order value, which we define as gross sales including taxes, divided by the number of orders, increased by 21% to £52. Focusing now on D2C revenue, the table on the left-hand side of the chart reconciles our KPIs relating to average order value and total orders to net revenue from our D2C channel. The increase in average order value and total orders resulted in a placed gross order value of £79.2 million, an increase of 38% on the prior year. After adjusting for cut-off around deliveries and VAT, revenue pre-returns grew to £66 million. The value of returns then reduces this to £44.7 million, as shown on the previous slide. Return rates increased by 9 percentage points to 34.3%, partly due to the change in sales mix between product categories after lockdown restrictions were lifted. The chart on the top right of the slide shows the relative change in mix year on year, with categories that typically have a higher rate of return, such as dresses and denim, increasing. In addition, the group temporarily experienced particularly high level of returns in the first half of 2022, as improvised changes in the supply base made to mitigate disruption caused by COVID-19 resulted in challenges in product fit. This normalised through the second half of the year. Finally, the chart on the bottom right shows D2C revenue by influencer. Our top 4 influencers still make up over 50% of sales, but we're encouraged by a longer tail of influencers who are now contributing meaningfully to revenue. Sam will talk more about some of our new influencers later on. Overall gross profit increased by 22% to £25.2 million. Changes in the D2C to wholesale mix resulted in a decrease to gross profit margin, which reduced by 2.2 percentage points to 43.9%. Direct-to-consumer gross profit margin remained flat at 52%, as Sam mentioned earlier. The group incurred cost inflation due to well-documented supply chain disruption caused by first COVID and then later in the year, the Ukraine-Russia conflict. Increases in average revenue per order were there largely offset by increases in raw material costs and increased rates for both air and sea freight. These cost pressures were more challenging to mitigate as effectively through our wholesale channel, where prices are set in advance. Wholesale gross margin reduced as a result to 15%. On to underlying costs. Underlying costs, which include distribution, marketing, salaries and overheads, increased by 44% year on year to £24.6 million. The largest element of this is our distribution costs. Distribution costs include postage, direct warehouse costs and transaction fees, and these increased by 35% to £10 million, which was equivalent to 17.5% of revenue, up from 16.6% the year before. The group incurred increases in direct warehouse costs due to staff labour inflation and increased out-of-hours operation to keep up with rapid growth, and the outsourcing of returns on a short-term basis to conserve warehouse space. It is expected that by moving to a larger warehouse, we will be able to gain efficiencies on a cost per unit basis, and we are delighted to confirm that post the year end, we signed into an agreement to lease a building in Lancashire. It isn't anticipated that we'll be fully operational in that warehouse for the second half of this financial year. Marketing costs increased to £7.1 million and represent 12.3% of revenue. The majority of marketing costs relate to influencer commissions, which are paid based on the contribution success of the product. People costs, which exclude direct warehouse costs and those costs capitalised for development spend, increased by 52% to £4.3 million. FTEs, excluding warehouse colleagues, increased by 69%, with investment primarily made across product development and technology. In addition to people costs recognised in the income statement, £0.6 million of salaries were capitalised. Overheads increased by 77% to £3.2 million in the first full year post-IPO. Of the £1.4 million increase in overheads year on year, £0.3 million of costs related to just being a listed business, and other increases related to supply chain governance, tech infrastructure, and service to improve our platform, along with an increase in other cost lines following the easing of lockdown restrictions. As Sam mentioned before, all of these costs relate to professionalising the business and operating at scale. Adjusted EBITDA for the year was £0.6 million, which represented an adjusted EBITDA margin of 1%. We did expect a reduction in adjusted EBITDA margin, as during the initial pandemic period, the group's cost base was abnormal. The group had been running off a skeleton staff base and had a reduced levels of costs in a number of other areas, as outlined earlier. The chart on the right-hand side then bridges adjusted EBITDA to free cash flow. Movements in working capital resulted in a £4.1 million cash outflow in the year. The primary reason for this was a £3.5 million increase in trade receivables. The increase resulted from growth in our wholesale channel, with those customers typically operating on 60 to 90-day payment terms. The group cancelled its invoice discounting facility in the year as it was on unfavourable terms, but I'm delighted to say that following the year end, we've agreed a new facility that does provide liquidity over this element of working capital. Stock increased by £1.2 million. Increased stock levels are as a result of an increase in purchase prices, additional volume held as a business stocks up to fuel growth, and increased levels of stock in transit as we look to gain efficiencies by moving to a free onboard model. Stock cover remains well controlled at around 6 weeks. Payables increased by £0.6 million, resulting in an offsetting cash inflow. Total capital expenditure was £2.1 million, the majority of which relates to the development of the group's web and app platforms. Costs related to the fit out of the group's new head office are included with the £0.7 million fixed asset costs. The income statement shows items below adjusted EBITDA. The group incurred depreciation and amortisation charges of £1 million in the year, and in addition incurred £0.9 million of share-based payment charges, primarily relating to options put in place at IPO. £0.2 million of exceptional items relate to the board's reorganisation during the second half of the financial year. The group made an operating loss for the year of £1.5 million, and after minimal finance costs which relate to leases, a loss before tax of £1.5 million. The statutory cash flow statement shows total cash levels decreased by £6.1 million, with a closing cash balance of £5.8 million at the 31st of March 2022. As previously stated, the majority of this outflow related to working capital, with £3.5 million of that relating to trade and other receivables. To reiterate, following the year end, the group has entered into a new invoice discounting facility to replace the one cancelled in December 21, which gives liquidity over trade receivables up to 85% of the total balance. We are focused on managing cash tightly and fully appreciate the need for prudence as we navigate the challenging consumer environment we currently find ourselves in. At the end of June 2022, the group had cash of £10.5 million on the balance sheet. Slide 15 shows the statement of financial position. We have quite a simple balance sheet, and we've covered most of the main points already. We ended the year with net assets of £10.7 million. I'll now hand over to Sam, who will talk to the operational progress that has been made.
Thanks, Rich. So I'm proud of the team for the progress they've made in revenue growth in the last year, building on the strong success we saw in the pandemic year. And as I said previously, and as Rich has talked to, almost a trebling of the revenue in that time. The business successfully scaled and we made strategic progress. There is clearly work to do on improving profitability, and we've got a clear line of sight to do so. Now, what I want to do is touch upon a little bit more detail those three components of the business that I said underpin what we're about. And the first, of course, is our brand and purpose. The second is the influencer model, the way we collaborate with influencers. They input to the design and we launch them together, which is a great source of new customers in a really cost-effective way. And then the third component of the business is agile supply chain. I joined because it's a great platform to build from, and I remain entirely confident of that. So firstly, see a slide in front of you that shows the influencers that we signed in financial year 22 on the left, and on the right-hand side, how we go about thinking about the role those influencers play in our business. So on the left-hand side, you can see 10 influencers. I've talked to Stacey Solomon, and the reach that Stacey gave us was a significant part of our revenue growth last year. On the right-hand side, what I want to touch upon is how we think about influencers. And there is more to it than this, but I think in broad terms, we can think of our influencers in two groups. The first group are influencers that have significant reach. And by reach, I mean following on Instagram or TikTok, and for whom they appeal to a broad cross-section of the UK population. Stacey Solomon is the best example of that, of an influencer we work with. On the top right, in the top right-hand corner, you can see an influencer called Perry Sharn. And Perry is also the second roundel on the left-hand side. So you can see she has 400,000 followers, or she did when we wrote this presentation. It's north of 500,000 now. But essentially, Perry would be considered, we consider Perry a fashion influencer. So Perry has a much smaller following, but the following is made up of people that really follow her for fashion advice, lifestyle, if you in the broader sense. So there's two groups of people and they play a different role. So Stacey would give us really broad reach very quickly, and that's what she did. And she launched very, very strongly. Someone like Perry's revenues would build over time and lend us real fashion credibility. So what's interesting is you can foresee a scenario where the size of two influencers, one a celebrity influencer, another a fashion influencer, could be of a similar size because they're playing different roles and have different levels of engagement when it comes to fashion. So we've had a strong year on the number of influencers signed, and we're excited by our ability to add fashion influencers, and we've made progress in that in Q1. And as and when celebrity influencers become available, we'll work hard and we back ourselves to sign them. So if I now talk to some of the customer metrics, Richard talked to these, and what I would say is I'll touch upon here the opportunity. So if we start top left, that's platform visits. That's visits to our site and app over the course of the year, 2 years, I should say, 3 years and 2 years of growth. You can see there that we've shown consistent growth in the level of interest, if you like, that In the Style is having amongst customers, shown in site and app visits. And as I've said before, growing on top of the big lift that we saw during the pandemic, I think is a worthy achievement. If we look at bottom left, it shows us how frequency has improved over time. So from 1.5 times a year, so that's how many times does the average customer shop in the year? And that's including customers that have left us. So that's 1.5 times going to just over 2, going to 2.25. Now, we see a big opportunity to improve that further, and within the strategy, I'll talk to how. But essentially, we want to continue to deliver a great launch model, adding new influencers and optimizing the influencers that we work with. But we also see a big opportunity to serve customers better in between launches. And I'll touch upon that in more detail soon. You can see conversion has improved over time, and it's a good level at 3%. Now, again, we see opportunity there because we can get to 10 to 15% conversion during a launch, which would be, industry leading for sure. Outside of launches, we see a below industry level. Now, what we're clearly to see a below industry conversion between launches, we must be driving traffic. And what we can see is that we're able to drive traffic between launches, but our current offer isn't persuading enough customers to shop with us. And that's a clear way that we'll go about improving order frequency. Now, if we look at the number of active customers in the bottom right, the comment I'd make is we're delighted by the model's ability to attract new customers. So just above 400,000 customers in 21, new customers, and just below 400,000 new customers last year. That's a significant number of new customers for a business of our size. But you'll see the pink relative to the blue section of the column says that a bigger proportion of our customer base is made up of new customers than we think it should be. What we mean by that is there's a greater opportunity to retain more of those customers when they've joined. So that remains a clear opportunity for us. And again, building out the experience for customers in between launches is integral to that. If I just touch now a little bit more detail on the supply chain. I've talked, so this is the third part, the first part is brand and purpose. The second part is the social influencer model. And the third part is the supply chain, an agile supply chain. I've talked about the 7,500 new products. I've talked about the size ranges that we serve. I'll just touch upon briefly the price points, because one of the strengths of the model is working with the influencers that we work with means we can sell volume of a £20 item, a £25 item. We can also be very successful, albeit at lower volumes, but very successful in absolute terms with a £120 dress. So what we do each time is we think which influencers, how should we space those influencers out throughout the year, and what collection should we design with them? And that might be to serve a need where we think the customer is really looking for value. And it might be to serve a need where a customer wants the best of a Christmas, and we're going to design a collection of kind of beautiful dresses. And so the model gives flexibility. We've scaled it. There is more we can do, but we've got the flexibility and adaptability to respond to consumer trends. So they're the three core components, of the model, if you like. And I just want to touch upon the progress we've made in technology and data. And so we've made significant investments in CapEx last year in our technology, or significant CapEx investments in technology. And I'll call out a couple of things here. One is to improve and stabilize the platform to deliver the volumes that we've talked about, particularly the velocity of the Stacey launch and the number of launches that we're now undertaking, up to 4 a week. And so that's been successful. And we've made progress on data management within the business so that we can better anticipate and serve customer needs, and we can make it easier for colleagues to work. So we've invested in our platform last year. We'll continue to make investments. At this juncture, I don't anticipate us needing to make significant investments to move the business forward. We've got a well-invested platform. Just to bring this section to a conclusion, our purpose is incredibly important. It's to inspire confidence, and we have three stakeholders: people, planet, and community. And we've made progress on each in the year. So in working with factory base on people, we've got really good supply chain transparency now, and we've made progress on colleague engagement. In planet, we've worked with a number of third parties to bring both transparency and support communities. And also we developed with Stacey Solomon our first ever fully sustainable collection. And then in community, I talked about the partnership with Dame Deborah, which fell into this year. But the business has a habit, core to our purpose is to support good causes and charity. And two that I would call out is the work we've done with the Samaritans on Be Kind, which has raised a significant amount of money over time, and also the work we do with Pride. And so alongside clearly the three important parts of the model is making sure we have a strong, well-invested tech and data platform, and making sure that our purpose comes to the fore with our three stakeholder groups. If Rich and I, we've probably got about 10 minutes more now, which will allow enough time for questions. And thank you. So I'd encourage anyone else to please send questions in, and we'll do our best to answer them at the end. We'll certainly have enough time to do so. What we want to now provide you with is a clear line of sight to where we're going to take the company over the coming years. So we'll do that via strategic update from me. I'll then hand to Rich, who will talk through what we've seen in Q1, and then back to me to talk about what we anticipate delivering for this financial year. So what you'll see now with the title of Building a Strategy on Our Core Launch Model is essentially our strategy on one page. And we think that's important for clarity in communicating with colleagues, for clarity in communicating with investors and stakeholders, and also to drive focus in the business to say these are the things that matter. So you'll see the first thing is on the left-hand side is our launch model. So our launch model, as we've talked about, is a great source of cost-effective customer acquisition and a great way to continue to build the brand by partnering with people. And that will always remain central to what we do. I've said previously that we see traffic in between launches that holds up very, very well, despite the fact we're not marketing to customers at that time via the launch model, but the conversion is much lower. And what we can see is we're great at attracting customers. We do an okay job of retaining them and developing them. We've looked in some detail at this, and essentially there is an opportunity to build out the experience between launches. And what we mean by that is kind of threefold. That's assortment, and I'll talk to what goes into that. It's the way in which you navigate our site and app so that it's as good to browse as it is during a launch. And it's the way we market to customers in between. But just touch upon assortment in some detail. Essentially, we've got a much smaller assortment than our competitors. And the launch model essentially is we launch the product, we aim for 50% sell-through within the first week, and we then start to discount that product in preparation for the next launch, in readiness for the next launch. And Rich has talked to our stock holding is very good as a consequence. We've got a relatively small amount of stock when measured by week's cover, and it's a healthy stock file. And that we'll continue to manage that very, very closely. But what we can see is between launches, because of that model, you can arrive on our site and not find something you want to buy, because maybe you've been attracted by X influencer, but we're now launching with Y influencer, and that person doesn't appeal to you. And the influencer that does appeal to you, we're now discounting their product, and there's very few sizes available. So we'll build out the assortment to support that in three ways. One will be we're going to back more of the winners from launches. So we'll have a longer shelf life, if you like, of some launch product. Not many. You might anticipate one every 2 launches, but we'll put significant depth behind those. And we had experience this year where we launched a dress last Christmas with Jack Josser, who is one of our celebrity influencers, has been very successful for us. We've grown a business well together. a pleated dress that performed well at Christmas, and we took it into spring, summer in, of course, different prints and colours. That performed very, very well early on in Jan, Feb, so we could see the indicators were good. We then extended that into the tens of thousands in terms of a buy, which was way above what we bought originally, and we sold that through very successfully because it was our spring, summer dress of the season. So we'll be better at identifying those winners and repeating on them. We'll also build out what we are calling own brand. Essentially, if you think of wardrobe staples, so we don't intend to be a platform in the sense of offering the widest choice. What we intend to help customers do is build outfits and have a really good assortment of well-designed, well-fitted, inclusive product in between. So own brand will be a key part of that. And that's not where we've partnered with the influencer, but the influencer might help us market it. And then the third, we're not working on this now, and it remains a question for us, but could third-party brands play a role, not to drive traffic in the way that some of the bigger platforms are building their businesses, and that I believe they're taking the right direction, for example, Very is an example. But where we would work with third-party brands in areas that we would find it more difficult or more timely to develop. So that might be shapewear, it might be footwear, it might be underwear, but where we know that size and fit are important for our customer and our customer is looking for them. So the first part of the strategy is to build out the retail experience to equal the brand. And the way I kind of describe it anecdotally is Rich is from Manchester, I'm from Birmingham. If we went and spent time on the high streets in both of those cities, and I think if we said to our target customer, have you heard of us? We'd get a large number of hands. We wouldn't get as many hands up as our competitors, but relative to our turnover, we would. So this is a brand with real reach and resonance, and we need to build out the retail experience to serve more of their needs, but do so in a measured and controlled way, focused on our core customer. The second is reach through partnerships, digital partnerships. So what I mean by this, we partner with a number of retailers, ASOS, Lipsy, Zalando, where the benefit for us is they help us access new groups of customers that are loyal to those retailers. And the benefit for them is they get to work with an influencer and get access to great imagery and product that's delivered just in time, within the supply chain for that need there and then. We see an opportunity to build deeper relationships with a small and meaningful group of wholesale partners that help us access incremental customers and where we bring the best of In The Style to them. And some of you may be familiar with the work underway in the likes of Next. Zalando really pioneered it with what could be described as stockless technology, where we as the brand hold the stock, we digitally make available our assets for retailers to opt into, and we fulfill on their behalf. That has the benefit of expanding our assortment without the retailer needing to purchase more stock, and it gives us the opportunity to increase the sell-through of our launches without buying more stock. So it's a big opportunity for us. We're not developing that right now, but I've got experience of developing and launching that, and it's on our agenda for sure. And then the third part of the strategy, and naturally these are in three horizons. First horizon, we'd expect to be delivering and seeing value from these in the next year. 2 on a slightly longer lead time, 3 on a further lead time. But where you could see with the influencer at the core of our business, and one of the questions that's come up actually is, who else does this essentially? How distinctive are you? Which customers are you serving? So we'll answer that question. But essentially, influencer at the heart of what we do, signing 10 of the UK's most prominent kind of influencers and managing those relationships is at the heart of what we do. The influencer gets to build their brand in working with us and gets to improve their reach by working with us, and we get to do the same. So it's a win-win. And at the end, I'll ask Rich to just outline how the economics of that work. But essentially, we can see a number of areas to take that business model further forward, and that might be serving a younger customer than we serve now, but using an influencer base to do so. It might be helping an influencer power their own brand, where we're the engine behind it. And it could be, how do we connect with micro-influencers using technology? So a micro-influencer could be someone with 5,000, 10,000 followers, clearly less reach, but deep engagement. How do you do that at scale? So in all of these, we'll stay true to the core of the business. And in something like that last, we'd want to develop the technology for us to be able to scale, and then think about how we might take that further. Now, I want to repeat that we're doing desktop analysis on this at the minute and feasibility, nothing more. And I don't anticipate having any news on these within the next year. But it points in our mind very clearly, and hopefully to you as well, the potential that exists in the business above and beyond what we're doing now. But even in Horizon 1, there's significant potential because there's good traffic between launches that we're not serving well enough. I'll now hand to Rich, who will talk to how we're performing in Q1. And then Rich will hand back to me to share some thoughts on what we anticipate delivering for this year.
Thanks, Sam. So trading through Q1 2023 has been robust. Through the first quarter of the financial year, we kept up the velocity of launches with 44 ranges launched in the quarter across 18 influencers. All of our customer KPIs have continued to improve, and return rates have normalised in line with our expectations, as they did in the second half of financial year 22. Through Q1, we've seen year-on-year revenue growth in our D2C channel of 12%. This includes revenue generated from the collaborations with Dame Deborah James that Sam mentioned earlier, the profits of which go to the Balbe Fund for Cancer Research UK. Total revenue, D2C and wholesale, was broadly flat year-on-year. Wholesale revenue decreased year-on-year as we reviewed how we launch our launch model works in physical retail, as I outlined earlier. Our overall gross profit margin was in line with the first quarter of financial year 22. And as I said, at the 30th of June, the group had cash of £10.5 million.
Thanks, Rich. So if we go back to what I outlined at the beginning, my reflections in the first 6 months as the new chief exec for the group, working with Adam and Rich, very, very strong model, but there is a number of ways we can develop on it, and hopefully that's clear in the strategic update I just gave. The customer base is improving in its dynamics, and we can serve them better. But I also reflected on naturally a business that's almost trebled in 2 years and done so during a pandemic. There is opportunity to refine the way we work to do 2 things: to improve the cost base, cash generation, and to give us the space and time to prosecute the strategy that I outlined. If we think of that context, then head into this year, where we expect, I think the industry expects the second half of the year to be more challenging from a macro perspective than the first half, as consumers return from summer holiday, as they look forward to perhaps a bigger Christmas than last year, but with a number of months in between and a World Cup held at unusual times. And then as we think about the start of the new year, the new calendar year, and we anticipate people looking forward to holidays for sure, but we anticipate both September/October and January to be key moments in consumer confidence. We've got to set out a plan, to steward the business well through the next 9 months. And we want to achieve, improvements to the cost base on the trajectory heading into the new year. We want to prosecute the strategy, and we want to continue to develop the core influencer model. In doing so, we anticipate delivering revenues at broadly flat year over year, and we anticipate making a £2 million EBITDA loss. Now, as we then look forward beyond that, we'd expect to exit the year in good health, and will be the plans that we've outlined on the cost base, we'd anticipate making progress on in the second half of the year, so that the run rate heading into FY24 is at an improved level. And that's essentially our outlook for the year.
That's great, Sam. Rich, thanks once again for your time this afternoon. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. As Sam said, this may take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of In the Style Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and may I wish you all a very pleasant afternoon.